Well, 1 in 5 homeowners in Australia are at risk of losing their homes if interest rates rise by as little as 0.5%. That's according to new research based on surveys of 26,000 Australian households. Martin North from Digital Finance Analytics was involved in the study, and he joins me now live from Wollongong in New South Wales. It's terrific to have you with us today. Can I ask you firstly, what's the definition of housing stress?
Well, we look at essentially how much income is coming into the household, what's left after you've paid your essentials, and then can they pay the mortgage. So there isn't a fixed proportion. It varies very much on cash flow and everything else. But essentially the question is, are they able to make those monthly repayments on the mortgage without difficulty? If they can't, if they're putting more on credit cards, if they're having to cut back elsewhere to do it, then they're in stress.
Now, if we're talking about a rate rise of 0.1%, how much a month is that on an average mortgage?
Well, the issue, of course, is there's no such thing as an average mortgage. So that if you've got a mortgage of $200,000, it's not much. But if you've got a mortgage of $1 million, it's quite a big amount. And that's part of the problem, essentially, because what it means is that larger mortgages and those perhaps with bigger properties are much more leveraged when interest rates rise. So in fact, a lot of the problems we're seeing is not in the people that we would expect on the outskirts of towns with relatively small mortgages, but it's people with larger mortgages and therefore are much more leveraged up.
So geographically, whereabouts are they?
Well, there are areas in and around the main urban centres. So, for example, people who've bought into the high-rise apartment markets in the centre of Melbourne and indeed Brisbane, and to some extent in Sydney, are very, very much at risk simply because they've had to get large mortgages to buy large value properties, even if they're very small properties. We're also seeing, for example, areas up in the northern beaches around New South Wales, particularly at risk. And so there are pockets in various areas. Up in the Central Coast is another region up there. We're looking at older people who still have a mortgage, even now they're thinking now of perhaps working less or even moving to retirement. They've still got the mortgage, they've still got to pay the bills, and essentially their incomes are rather contained. So it's a smattering across various locations.
Some people in our audience may be asking the question, how can this be? How can people be stressed with an interest rate rise, a potential interest rate rise of 0.5%, given that interest rates have only just recently risen from record lows?
Well, that's, of course, it. We've had very low interest rates for some time, and people have been leveraging up because, of course, the property market has done really well over a long period of time. The banks have been willing to lend, and whilst they've tightened their underwriting standards relatively recently, I think they're still quite sporty sometimes with what they get. But these households have other commitments too. They have the cost of childcare, for example, the costs of electricity, gas, all the other stuff, all the the things that actually make life go by. So effectively, you can't just look at the mortgage commitment in isolation. And I think probably a lot of the lending that's done at the moment doesn't take full account of the real life experience of households and the multiple demands on their bills.
And so for any prospective homeowners watching, how many interest points above the current one should they be prepared for?
Well, interest rates are very, very low at the moment. The average mortgage rate, you should be thinking about 7.5 to 8.5%. Typically, a mortgage rate will be about 4.5%. So let's say 3% higher than current levels. That's a middle of the road estimation. So I think people should be thinking about what happens if rates go up. Do they have a budget? Do they understand essentially how much money they've got in the bank and how much they will need if rates go up? And I think that people who are committing to properties now, particularly with rates so low, need to ask these hard questions about what happens if rates go up.
Martin North, terrific to talk to you.
Thank you.